All right, I think we're going to begin here. Hello, everyone. My name is Oren Winnick. I'm the Executive Vice President of ACG in Los Angeles. And on behalf of the board and everyone at ACG, I want to thank you for participating, especially to this esteemed panel that we have tonight, in addition to our moderator, Managing Director at FocalPoint, Mike Schall, who helped curate this really incredible evening. So Mike, thank you to all of your work today. You know, in my day job, I am a partner and part of the leadership of a firm called Experian. We're a multifamily office, and we work with, kind of founders and leaders of middle market companies, many of whom are in food and beverage. So like many of you, I am very interested in today's discussion. We know that there are challenges and opportunities in food and beverage. We're going to hear about all of them. Before I hand things over to Mike, I want to bring in Sheena Nickerson. Sheena runs our digital strategy here at ACG, and she's going to walk us through some of the technical logistics. So Sheena, if you could do that.
Thank you, Oren. Today's panel is from 4 to 5 p.m., followed by a networking session from 5 to 5:30. All registrants should have received the separate Zoom information for our networking sessions via email earlier today. However, if you didn't receive it, we will put that information in the chat box 15 minutes before the end of today's panel. And with that, I am going to pass it over to our amazing moderator, Mike Schall.
Great, thanks so much, Sheena and Oren. Thank you very, very much. And on behalf of ACG, our colleagues, I want to thank the panelists as well. Welcome, Seth and Chuck, David, and Tony. Each of these panelists, as I'm sure you know, represents best in class in their segments in the food and beverage ecosystem, from growth capital through supply chain, and ultimately an obsession with their customers, because that's really where things begin and end. So in addition to that, since everyone has search proficiency in LinkedIn, more often than not, they need really no introduction. If you don't know them now, you'll know them by the end of the hour. These participants are deeply aligned and driven by their core values. They have a great sense of purpose, and they thrive on both disruption and innovation in an entrepreneurial fashion, and continue to lead the food industry into the future. So we're not going to dwell on the past here. We're going to really focus on going forward from what was an extraordinarily asymmetrical, adverse year. And all of these team leaders have proven very, very resilient throughout that. So let's learn more from them now and where we're going, and more importantly, proceed. So with that said, what I'd like to do is my first question will be to Tony, the CEO and Erewhon Markets. And Tony, the pattern here is I'll ask a question and then we'll pass it along to the panelists and move on. And but thinking about your business, what 2 or 3 factors contributed probably most harshly to disruption, and perhaps even created opportunities for you and Erewhon that's going to change the way you think about the next couple of years? I mean, we don't want to dwell on the past, moving forward.
Thanks, Mike. So definitely online grocery. I mean, online grocery spiked. It's now sustained, and we've needed to learn the entire front and back operations, because prior to COVID, we didn't have online grocery. We used Instacart, like many of us do still today. We had to train staff. We had to get that all rolling, and it took us about 2 weeks to get it up. Thankfully, we had it plugged in and ready to go. It's stabilized. It's now we're just looking to figure out ways to keep the relationship with the end user and not through the third parties. That would be our probably our largest ability through COVID. And the second most concerning is inflation. I mean, inflation's a real thing. People ask me all the time, are you seeing it? Boy, am I seeing it. I see it everywhere. It's been high. The inflation's unbelievable in food service, sooner than we're seeing it in the retail side of things. Retail takes some time to catch up. Just need to learn how to manage through it, sourcing, recosting recipes. We're doing anything to work on that as well. That's definitely our number 2.
Great, thank you. Chuck, what are your thoughts?
I mean, from a food distribution company standpoint, I think it really made us relook at our portfolio. Prior to COVID, everything that was hot and sexy was grab and go, on the go nutrition. And that just totally changed things. So, we were really blessed, seeing foot traffic down in these stores and not being able to get the prepared foods set, like all those grab and go options really, felt the impact. So it made us look at our portfolio, and now things that were not shining in our portfolio, like grab and go ramen, not grab and go, but take and cook ramen, like that's something we never entertained. It's like blowing out of the water. Like there's just this more obvious, cook from home mentality. And so we just really had to, we were very focused on grab and go, and now we've got a much more diverse portfolio.
Terrific. David, you rely on a global supply chain for not only some of your portcos, but share with us one or two of the consequences that you see are going to affect you going forward. You're on mute.
Sorry about that. Managing resources the next 12 to 24 months. I mean, I tend to think of it a little bit differently. First of all, I think about it in terms of finishing the second half of the year strong. All these companies have budgets that are in place and reforecast numbers. And so anything that we can do to support them on that front, it's a little bit ironic. We're finding that, with all the stuff that was going on in COVID, actually, the supply chains now are just feeling more disrupted than they were during COVID. And so there's a lot of times where we're having to kind of air freight product from Europe and doing a lot of things that are outside those budgets, but you got to do it right now to make sure you're on the shelves and kind of thinking long term. So I would say that that's one area. The second one that, we wrap our head around is trade spend. This is something coming at it from the brand standpoint that's often misunderstood or hard to evaluate. My gut tells me lean in and make sure that you're staying a market leader, and that, focus, everyone focuses on sell-ins. I focus on sell-throughs, but so in that we're kind of investing in a lot of that. And then the third thing I would just say is just focused on double down on omni-channel. You take a look at like our company, Van Leeuwen Ice Cream is a perfect example. Where you have a physical scoop stop and you go into a Whole Foods, you're doing 6 units per store per SKU per week. You go into that same Whole Foods in Seattle and you're doing 2 to 3. So we're committed, rightly or wrongly, over a longer period of time to kind of building out that omni-channel presence to support the sell-throughs.
Great, thanks. Seth?
Yeah, I look at it from the consumer perspective, and I think that's where there's been a huge disruption. I think consumers are really fundamentally re-examining the way they think about food, and I think in particular, where no surprise, I think there's been a shift about animal products in particular, so animal-based products. And I think whether you look at the pandemic and say that was a zoonotic, based disease, or you look at the disruption, what happened with the animal packing plants, and people got a little look under the inside of that and the working conditions, or even just this feeling like, the pandemic really underlines we are all interconnected, and decisions people make in another side of the world can affect us. I think there's been a shift in the mindset to try to get toward more holistic approach to living, and obviously eating being the thing that we do every day. So I certainly am doubling down on the idea that plant-based is going to be where people are going to continue to look.
Great, thanks. It's really interesting because as I lean into the second question here, Seth, it was really directed toward you, because I'm sure most people are familiar with your role as the co-founder of Honest Tea and in your board role at Beyond Meat. But what is really people may not know is what's literally beyond. So obviously plant-based foods continue explosive growth. And I was just curious because you participate both in the consumer side of plant-based foods as well as the food service side, right, with your ventures. If you could share with us, like you just did, a little bit more beyond the sensory effects of products, and what
Yeah.
are you thinking that are really driving this tremendous growth in plant-based eating?
Yeah. Well, we shouldn't overlook the sensory effects. I know you say beyond it, but just to make sure we all recognize that, the plant-based products that are being sold today are not what were being sold even 5 years ago. The Beyond Burger was just launched 5 years ago this spring. So before that time, everything that was vegan or plant-based, well, it wasn't called plant-based number, it was called vegan or vegetarian. It was sold in a freezer, and it was sold to sort of 1% of the market or 2 to 3% of the market. Today, because there's been a step change in the quality, texture, and sensory aspect and nutrition of these products, they are now carried in the meat section or on the menu of mainstream chains, and that helps make them more accessible to the consumer. And then when you pair that with this shift in mindset I talked about, I do think you're seeing new opportunities for consumers to get exposed to this and to habituate their behaviors to it. So yeah, we've launched this brand Eat the Change, which is a plant. It's at the juncture of snackification, which is another big trend. People are moving away from sitting down for 3 square meals a day. They're snacking more. Then there's the obviously arrival and emergence of plant-based food. And then this idea about the climate change is real, and people are recognizing they do play a role in it. It used to be, well, I can vote and I'll take a stance there, or I'll drive a car, I'll buy a hybrid. But that's not enough now. Now it needs to be everyday choices. And so whenever we, and collectively, can give people more plant-based options that are as good or better, then we get we earn the right to engage them more. So I just think this is it's a convergence of the retailer, restaurateur, and the consumer all recognizing this is a behavior that it's a direction that makes sense for them to be in.
I couldn't agree more. As you know, David, what's your thinking with Alter Eco and the concepts that you're working with and seeking out?
Yeah, I mean, I think some trends beyond sensory. Certainly we're exploring and seeing a lot in functional, right? So that's an area that people are spending a lot of time on. Chocolate with ashwagandha. You've got coffee with mushrooms. People are, doing things with melatonin, all kinds of different things. I mean, we have a company called Smith Tea that's launched a new cool plant-based greenhouse concept, and the best-selling item on the menu is turmeric tea soaked noodles. So, we're getting there, and I think the younger consumers are demanding this stuff, and I think that's an area that's really been a strong one. The other one and I don't know if exactly this is on point, but ESG has been a huge component of this as well. I mean, we insist on having, Alter Eco truffles in compostable wrappers. And now you're starting to see consumers start to set TikTok videos around where they're planting the compostable wrapper, which is kind of cool. I mean, Van Leeuwen ice cream is another one where deliberately going for oat milk, because obviously oats are more sustainable than almonds, and so we've been working through that point of view on that. And then regenerative egg, right? I mean, I'm not an investor, but Quinn Snacks is a perfect example of where they're putting videos out there showing where they're sourcing their raw materials. These are all things that I think are only going to magnify and grow and grow and grow for years to come. So the one point that I would make, Mike, is, and I don't know how it plays into this overall thing, but I also think consumers are getting more price conscious, especially as private label becomes, as a lot of the retailers lean in on private label. And so that's going to be an area for discussion down the road as well, I think.
I agree. That's a good point, Chuck. I'm sorry, David. Chuck, what are your thoughts?
Yeah, I'd kind of just continue on that point. When I look at Pitaya Foods in the frozen fruit section, talking about customer behaviors and with inflation coming, like they're looking for more bulk and value packs. So we're starting to drive a lot more of larger sizes, right? There's just more, people have more buying power. People are buying separate freezers. And so they're looking for bigger options to drive value. And I think that role is going to be even more significant as inflation continues to creep in.
Great. Tony, your thoughts?
For us at Erewhon retail, on the retail side, it's a little tricky, primarily due to our ingredient strict ingredient, maintaining those ingredients.
Mhm.
You know, I mean, plant-based products usually has got a lot of products in there that we don't allow as a ingredient in our retail products. But we're making adjustments to see how we can fit those things in. We realize it's an important category, and we love the category. People back in the day was all about Erewhon is about, vegan food. So we believe in it. We know it's true. It's just we wish there was a clean, ultra clean ingredient primarily for our cafes, because a lot of people come in and looking for a vegan item, and we make everything from scratch, but we would love to use a product that would fit within the organic profile, because our food service side of things is all organic, and that's what we wear our hat on and every day push for that.
Great. Yeah, thank you. That makes great sense. We're going to continue on to the next question in a moment. I did get a question from one of my colleagues in the audience about the larger food portfolio companies, food and beverage companies that are selling direct to consumer, and whether or not they should sell through an Amazon or through themselves. He says it seems like a few large food companies are trying to sell direct on their own sites. And I know, Seth, you've had some experience with that, and Tony, you have as well. So brief response to that, and we'll move on to the next question, if that's okay.
I mean, I think they got to sell everywhere you can. I don't think it's an either or. So obviously you invest in your own site, you get better margins, but you just wouldn't make sense to exclude, the other ones. And certainly, look at these new brands we're launching. Obviously we can go direct, but we're investing in retail because in fact, I just finished last month. I was in every one of Tony's stores personally handing out samples, because there's no substitute for meeting the consumer face to face. And this was one of the first in-person demos I was able to do, but no substitute for meeting someone face to face and being able to have them taste the product, with you there, so you can help give them that context. And it's obviously much more cost intensive than any other way to do it, but there's no better marketing out there.
Thank you.
I mean, we believe in it. It's here to stay. I mean, direct to consumer is the way of the business. I mean, especially, Instagram and all those guys it's so easy, and it makes a lot of sense. People nowadays, I mean, will drive that, and that's a growing piece of that side of the business. But on the retail side, it really doesn't worry us, because we get that marketing, and people want food primarily. They want it usually same day, and they don't usually like buying cases. It depends on the product, especially. I mean, for sure.
Great, thanks, Tony. And speaking of which, we'll move on to next question here. I think the industry knows that over almost $250 million were traded out from food service and the shutdown in food service from away from home meal occasions. And obviously, supermarket retailers took a hit with hot bars and pizza and grab and go. There were some winners in the restaurant sector, pizza namely, and coffee shops. But Tony, from your standpoint as a grocery retailer, when do you think you're going to see a return to normal, whatever normal is? Because you're
Erewhon's unique as we are a retailer grocery, but our prepared foods is such a large portion of our business. I mean, pre-COVID, we were 35-40%, probably even more when you add in our private label food service type items, soups and that kind of stuff. So it definitely hit that side of the business tremendously. Our comps were negative 30-40% compared to grocery was up 100-150% during the crush. But as it started winding out in August, we started seeing the shift starting, and we're over our 2019 numbers currently. As far as the food service side is made up plus some from where we left off. And I mean, we did that while in the center of COVID, it was primarily we were moving more to grab and go products. So we were packing a lot of the stuff we were making. We consistently were hitting up new recipes, ingredients to stay relevant. But we see that it's back. I mean, we're already back to the norm and growing.
And Mike, just a quick fact check, because you said $250 million, but it's $250 billion that moved from food service to retail. So a few zeros there. You're on mute.
Got it. Thank you so much. Appreciate that. $250 billion. Yeah, Seth, so that's, back to you.
Yeah.
In the food service business.
Yeah.
now, so.
Yeah. I think look, food service is seeing a big resurgence now. And what I've cautioned our team is like, don't get too caught up in this. This is the makeup business that we're seeing, and everyone's eager to get back out. And so, but don't make your forecast based on what we're seeing, this month or even this summer. So I do think it'll normalize a bit, but what I hope happened was a little bit of a sort of correction, and food service was getting overbuilt, and frankly, we tell not every landlord wants to hear this, but we tell them, like, there's a different reality out there. It's going to be hard to get people to spend money for seating areas that really, tenants to spend money for seating areas that people may not be able to sit in. And so I just think smart restaurateurs are going to wait it out a little bit before getting into new leases. I mean, I know there's a lot, we keep hearing there's a lot of interest, but we still haven't seen the full shakeout of what happens with these restaurants post-COVID.
Great, thank you. Chuck, what are your thoughts?
So from a retailer perspective, high touch distribution covers, all the natural grocers in Southern California. And you see a real disparity based on location. I mean, the supermarket, the retailers that are located next to the Hollywood studios, those places are still empty, and there's no foot traffic in those places. Whereas, and there's also, I think the return to normal comes when these large corporate offices really start getting people back in their doors. And so I think what we're seeing is like over demand from people, just, the normal person who wants to get in there, but like the normal isn't coming until these studios are back online and these corporate offices are back in action. And then from Pitaya Foods, it was crazy. Like, I think we sell frozen fruit to juice bars and cafes, and those places were really well primed for COVID. They were all healthy, fast casual, grab and go. So we only saw an 11% dip in 2020, which in April, I thought it was all going to zero and I was moving back into my mom's basement or something. Like, so to just survive that, and only 11% was I think just a testament to our customer set at Pitaya. Happy we weren't selling to romantic Italian restaurants. Those, I feel bad for those guys. But I think, and that's going to be the sign of new normal, when people are going into buildings and really eating there as well.
Great. And David, your thoughts, on Ben Lewin?
So, I think I was going to go with this a little differently, which is, first of all, we're seeing a tremendous amount of activity in the restaurant space. There's a lot of deal flow out there. And I don't know, I think Seth's probably right. It's a little bit early. But two things keep coming back and forth in my mind. One is kind of urban versus suburban environments and how you think about to market strategies and where they're coming back. And, I'm here in San Francisco and there's no one on the streets downtown, right? So, I mean, not exactly, but to make a point, it's not anywhere like it used to be. And I don't know that it's coming back, to be honest with you. So, and then the second one is kind of understanding the dynamics, kind of natural to conventional channel, right? Because they're different. And I think that the great thing about the natural channel, albeit, a smaller footprint, and I mean, Erewhon's a perfect example of this, is just that focus on customer experience is so compelling that you want to make a day of going there. I don't feel that so much about Target, right? So it's one of those things where those are shifting and we're trying to figure that out. But you see it in this, when you invest in small brands, like, and you're looking at sell-throughs and you're looking at velocities and new doors and stuff like that, you're seeing natural come back much quicker than conventional.
Terrific. Well, speaking of normal, next question. Sorry, you picked the prize, David, but speaking of normal, we hear a lot in our respective organizations about normalized EBITDA. And so it's on everybody's mind. I'd like to ask you first, from your perspective, what are the determinants and what constitutes normal? Because as everyone's aware, there's either been a bump or a dip, a big one in the last year, and that's a big question. So David, why don't you take a stab at that?
Okay. So first off, maybe for your audience, it's important to make sure we're differentiating the difference between normalized EBITDA and adjusted EBITDA, right? Two different things. When you come to me and you want to sell your business and you're asking for a bunch of adjustments for one-time costs, that's a discussion, and some are real and some are not. Normalized EBITDA is a different concept. I mean, to me, EBITDA is nothing more than an accounting concept, and it's a benchmark more than anything. And so I would say to brands out there, if you know, if that's the audience or young entrepreneurs, whatever, I would focus less on normalized EBITDA, and I would focus more on the three things that investors think about. And one is revenue run rate. The second one is gross margins, gross margins, gross margins. And the third is cash in the bank, right? Because EBITDA will take care of itself in terms of how those things play out. And the challenge with small brands is they don't have a lot of levers to push and pull relative to managing EBITDA the way the larger brands do. And the reason I say all that, right, is when you ask the question about normalized EBITDA, I'm happy to give an entrepreneur credit for them saying, hey, in a pre-COVID environment, we were doing this and we want credit for that. But you got to show me that the fundamentals of gross margin, you know, revenue build and all that kind of stuff is right there, because then I'm more likely to give you credit for a normalized EBITDA. And yeah, the answer is it's coming back. I mean, Seth alluded to this. Food service, super strong right now. You look at our investments in like Samazon or some, you know, Smith Tea. I mean, they're ahead of plan on food service across the board. Now they reforecast down quite a bit, and now they're on the rebound. But I agree with Seth too. Be careful, because you're seeing a restocking cycle going on right now that is not necessarily, you know, the same thing as getting solid velocity. And so I think you're going to see some kind of bumps in the road there. But I mean, my answer just as an investor is even just the concept of normalized EBITDA is like the least interesting thing to me in a lot of ways. Like,
Hey, thanks, David. Tony, I see you're in agreement there. Sounds like, or it looks like you're in agreement.
Our same store comps will naturally be lower in 2021 versus the spike of 2020, but we're still comping positive as we are as of today. And for 2021, we're way ahead. I mean, our normal is 20% year over year. It's kind of where we are. We're opening stores and we're right there with it, and another store opening here in the next 60 days. So we're good.
Great, terrific. Seth, your thoughts?
Yeah, I mean, to me, the key indicators for a growth company is growth rate. You know, you got to have gross margin, and then it's growth rate. Our job, our charter is to grow and to grow faster than the big companies or really any other company in our category. And if we're delivering that with gross margins, we should be doing that all day long. And any investor who starts trying to beat me up about EBITDA, you're thinking about it the wrong way.
That's really insightful. Thank you. Chuck, your thoughts on this?
Yeah, I don't give it much thought. I just make sure that we're a profitable company, and you know, we're growing profitable and we're growing year over year. And the more profitable we are, the less we can block out any potential investor noise and focus on our businesses. And that's served us well over the past couple of years in both businesses.
Okay, great. Well, right back at you, Chuck. You know, this last year for all of you, I think for the entire industry, strained partnerships among every link in the supply chain, and in some instances, those relationships were irreparably harmed. I mean, there's been a lot of damage in the supply chain, and we have heard some thoughts about that being a key driver for the recovery of many of these businesses in the food and beverage space. So what are you doing? I'd like to ask the panel and start with you, Chuck. What are you doing to ensure that the partnerships going forward are strengthened and avoid that risk of failure? And I kind of call it a cultural HACCP plan. What are you doing to ensure that the suppliers that you relied on in the past will be there for you going forward?
So when I think of Pitaya Foods, we've got a pretty complex global supply chain. We source fruits directly from 7 different countries. And so quality and safety is what we pitch to our customers and throughout the supply chain. And that's what we're trying to make an impact on this world with by investing in supply chain. It's like what it's in our DNA. And so it's scary when we can't fly over to Asia and we can't fly down to Brazil, or we can't fly, to Nicaragua to see what's going on in these factories. So we've updated our standards. We've got a foreign supplier verification program. So we've added amendments to that to make sure suppliers are up to speed and qualifying for us. We've added like virtual audits. So we'll have walkthroughs to the factories, which is kind of a substitute. There's no substitute for physically me being in that factory. And, it can get scary. There's definitely, I'm dealing with fruit, and I've seen things in facilities that, would not qualify to be a supplier from us. Can't imagine what that looks like from a protein meat kind of perspective. So it's scary. So to answer the question, we're just upping our qualifications, and we're also not looking at new suppliers, right? Whereas we would probably have onboarded 2 or 3 more suppliers to be maybe a little more redundant in the supply chain, but we can't really bring on anybody on board unless we physically see these facilities. So we're leaning on our current partners more and trying to develop more items with our current supply chain rather than really growing and expanding it. Optimistic that we can start getting back on flights in 2022. I don't see that happening for the remainder of this year. So that's kind of how we're managing it as well. And then it's from high touch distribution, where we work with about 40 different brands, and it's to see the supply chains, the out of stocks that we have coming from these brands when there's like no cans in the market, there's no bottle caps, there's no anything. I mean, we've seen every excuse from these 40 different suppliers, and that's tough when you show up to an Erewhon and they're like, where's this product? And they're depending on us, and it's a strain on the communication between supplier, us, retailer, right? And so and trying to fix that and manage that, and so we try and take a proactive approach to to tell these retailers this is not us, this is them, and it's hard because we're the ones showing up with the trucks. So it's just try and communicate to no end.
Well, Chuck, I think you literally have double duty, because you're the CEO simultaneously of both a consumer packaged goods company and a distribution company. So you come from a point of great authority. Thank you. David, you have a global supply chain as well. How'd you make it through, and what are you doing going forward to ensure that you continue to make it?
Well, we're not through yet. So it's just, I mean, I feel like I've gotten a PhD in supply chain logistics, and for those of us in private equity who actually don't do anything for a living, this has been a really tough time to kind of figure out stuff. But I think what we've tried to do is look at it as you have an opportunity when there's a lot of change and disruption. Don't let a crisis go to waste, and it shakes up the status quo, right? And so we've tried to kind of lean in and start doing things that we always knew we should have done, like finish off that NetSuite implementation and make sure your inventory planning is and you actually know what your gross margins are, right? Switching 3PLs, which is something you think about and then you never do, and then the risks are always there. We said, screw it, now's the time to do it. So we've been doing a lot of that. Bringing as much as we can back onshore production has been something that has been a priority for us. I mean, I've got a ton of inventory sitting on boats in the middle of nowhere that I need on the shelves. And so even beyond just kind of like whatever you can get the best product contribution margins, like even just the supply chain has become so convoluted that we've been trying to move back on shore. I think creating redundancies with co-mans has been a super important thing, like making sure that, we can manufacture in more than one place with certain things has been another thing that, takes some dollars. And I'd say to entrepreneurs, like, make sure you have an investment partner that values that. And it's because you don't see it. It's not sexy, but it's like a super important investment to make in the strength of your business.
Thank you. Let's see, Seth, again, from the standpoint of global supply chain and currently now with a lot of mushrooms and a lot of interesting
I picked a good time to shift away from international, tea supply chain to domestic. Yeah, we source our mushrooms from a fourth generation family farm in Pennsylvania. So we just drive up and visit with them. A lot of FaceTime, a lot of communication. I think one of the changes is we've told all our key suppliers we want to have twice a week check-in calls. And that's pretty high touch, but they get it. They understand. And that way there's no surprises. We know, look, if there's a COVID outbreak in the town, we hear about it. If there's a problem with trucking, we'll hear about it. And we just got to be informed so we can communicate up to our partners as well. The other thing I'll share that's interesting, we've just started to do now is tell our suppliers we want to understand what's your ransomware plan. How are you dealing with that? And what's, so that we don't get stuck on it. That's obviously a new trend, but it's something I think we're going to see continue.
Yeah, actually, that was one of the lightning round issues we're going to talk
sorry.
about. So you're always one step ahead of us. No question about it. Tony, your thoughts on your relationships?
Yeah, Mike. So we're pretty lucky that most of our distributor relationships were, both retail, food service, and produce have all been in place for many years, and we have great relationships. But of course, in the middle of COVID, when our shelves, I have pictures of our shelves that were completely empty. It looked like a new store just setting up. They were wiped, and we couldn't get inventory. Unify is our primary distributor, and it was tough. We were picking up. We were doing everything we could possibly do to get inventory when they weren't shipping anybody. And they were shipping, but they couldn't catch up with it. So it was a nightmare, but we've tried, and we believe our relationships are good, and products back on the shelf, and we're doing great. So,
Excellent.
It worked out.
Now, there's something to be said about legacy relationships and honoring your word. It's a handshake business still in many cases. So I know Tony and Seth, obviously David and Chuck, you share those beliefs. Last question in this segment. I think everybody would agree that the last year was a lost year by and large, at least for presenting new items at grocery, demoing, executing at retail, ads because you didn't need ads. And as a result of that, investors now, folks, I think like David's ilk, other private equity, have been sitting on the sidelines for a little while. The dam seems to have burst in the last 60 to 90 days. There's a tremendous energy around investment. So, David, let me ask you first, if you don't mind, again, taking this one. Are you planning to deploy resources and, with existing businesses and perhaps new platforms or new opportunities? Is it a build, invest and add on, or is it a acquisition? Just general thoughts.
Well, I don't know that I would necessarily agree that it was a lost year. First you had a real shift towards D2C in a way where, I could rip up the old business plans, but many of our businesses grew anyways. And this is about growth, mostly on the back of stocking up pantries or migrating to D2C. And so the business margins might be jumbled up, but I don't know that it was a lost year in that sense. And candidly, it was a time to focus on fundamentals. I do think it accelerated a basic reality that people like me face, which is, we're at the tail end of a cycle where guys or gals like me used to kind of try to find the hot new beef jerky company, jam it into the channel, trade spend be damn, gross margin be damn, and try and sell it to a strategic, right? And there's just model after model after model of companies that have been doing this for quite some time. And I think those days are numbered, to be honest with you. I really do. And I'm not saying strategics won't make the occasional acquisition and that kind of stuff, but I do think that it's shifting, and it's shifting more towards these authentic, real things that people like Seth have been building on and doing, these seismic change in the what people want to buy and how they want to buy it, these new categories, which are all incremental. And I think they're focused more on the omni-channel side. So I would say that when you ask the question about where we're trying to invest, I would say it comes back to really culling through the portfolio and figuring out who's figured out the flywheel of growth, who hasn't, right? Who's figured out gross margins that make sense. I mean, I've probably looked at every plant-based beverage on the planet. I can't find one that has gross margins that makes any sense, right? So, and there's a lot of smart people are making money, so don't get me wrong, but it's just kind of one of those dynamics. So for where I am, I'd say the answer to your question is we're being super careful. And we're trying to do fewer things, put more money into them, and be there 360 for that company and really dominate that category or do something unique versus spread it out and try and find the hot thing.
And this is not new news for you, David. So well said. Seth, your view.
I think what I agree with everything David said. I think one of the interesting things that's happening is that the big companies, I don't want to say they've given up on innovation, but they've just recognized this is not their wheelhouse, And so it used to be they would let the small companies do it, and then they would buy them. But now we're seeing big companies just basically saying we got to stick to our knitting. And I go back to a company like Coca-Cola. They basically they cut a lot of their sort of future-leaning brands. Unfortunately, not on the sea, but that would not happen in a expansionary period. They would have said we got to go invest in these, and so that's going to be. I don't think that's a permanent trend, but I do think some of these big companies are just kind of like they got to reorganize the decks. They've got to figure out what they are going to do and what they'll try to buy, and so. I still think there's great opportunities for entrepreneurs, but I also think, like David said, don't build a brand, with the idea you're going to don't flip. You're not going to be flipping a brand anytime soon. You got to be prepared for a long haul to own it and build it.
Great, thanks, Chuck. What are you thinking?
It definitely wasn't a lost year for Pitaya Foods. I think when this started happening in the first quarter, second quarter, we were really nervous and we held off on new hires and stuff like that. And then now we're like playing catch up. We've seriously hired a lot more people to support all this growth, and we're really optimistic about what we have in front of us. High Touch was a different story. We, when the pandemic hit and everything got flushed out of the supermarkets, we saw incredible sales and then everything went to zero. But I think what we were able to shine in that spot is a real person to call, a smaller distributor, right? Like Unify was all blocked up, but it wasn't a competence issue. It was just capacity. And there was every single brand was calling Unify. So I think a lot of these other brands and a lot of these other retailers really leaned on us. I mean, listen, when this pandemic hit, me and my COO were at Erewhon a week later meeting with your team, Tony, saying, we're here, what can we do? And so I think that bought us a lot of brownie points. And I think that, with the suppliers as well, like you'd go into some of these retailers and the things that were stocked were using regional local distributors. So I think,
very much so.
It wasn't great financially and we just kind of muscled through it, but now we're building out a new 25,000 square foot warehouse to support. We're taking this bet that, this love that we earned during this time is going to pay off. So we're excited about the future to just keep digging deep in our territory.
Well, we know you can serve as Tony, that's for sure. Tony, lightning round here.
So yeah, I mean, we're using it. Retail real estate has definitely been hurt. Definitely not a good thing to be in. We're seeing some opportunity from, normally we just lease space. We're looking at a couple sites right now where we're going to be buying, and that's a whole new market for us. And for sure, interest rates being where they're at, it's just that much more affordable with the hurt. But we're looking at that whole side of it, whereas normally real estate wasn't our forte, but we're looking at it a lot more serious.
Excellent. Well, this has really been great. We have about 15 minutes, maybe a little less, and I know a couple of you have to end at the top of the hour there. So what I'd like to do now is go through what I affectionately term lightning round. It's either thumbs up, thumbs down, high risk, low risk. got a handful of ideas here that I want to share with the group. And they're specifically focused on the next 12 to 24 months of business. You might ask why we chose that and not a longer time horizon, but honestly, my psychic down the street closed last year because she couldn't see a future in it.
Wow.
So with that said, let's go from low risk to high risk. Shifts in consumer behavior, direct to consumer, platforms like GoPuff. Seth, let's start with you because you're on top left here. High risk, low risk. High impact, low impact.
High impact is shifts in consumer behavior. And for me, I see it as a positive, just continue that direction for sure.
Great. Tony, I think we know your answer.
Low risk, not super worried about it. I think it's good.
Okay. David, what's your thoughts on these consumer shopping behavior changes? High risk, low risk.
Well, I won't comment on the valuations in some of these companies. That's a different parameter. But in terms of consumer shopping, I think the more places people can buy things, the better.
Great. Chuck, I'm sure that's the same for you. Pretty low risk, great opportunity.
Pretty low risk.
Great. What about, let's just throw out labor. High risk or low risk? Tony.
High risk. Terrible labor market right now.
Yeah.
Right.
Yeah. High risk as well. Yeah, we see it.
We've had the last 12 to 24 months, but I think September, once the government stops, sending out free money, is going to make people want to get back to work. That's what our belief is, but it's tough right now.
High risk. We can't even find people to work in our Spanloo and Scoop shops. But I sometimes wonder if it's a labor issue or a wage issue, because I feel like maybe we should be just paying more, but that's just me.
Is working from home a headwind or a tailwind? Tony.
Bit of a headwind. I mean, most of our store labor was always in store, but you're getting people that are saying, I'd rather just stay at home. I can do, this job. I can do it from home. It's a lot easier. It's a problem.
Yeah, David.
Yeah, I think it's a challenge. I think businesses are about teams and teams need to gel. But I also believe that we'll never go back to the rigidness. So finding that right balance and the flexibility can be a positive, but it's definitely a challenge.
Great. Seth.
I think it's a good thing to let people live their lives sort of where they feel is their highest capacity, as long as they are willing to come to the office when they need to be there.
Chuck?
It's been a challenge, but it's hard to say it's a challenge when we had our best year ever at Pitaya Foods. So how can I say that people weren't working from home? We had a really successful year. However, the reality of the situation is we just opened a new office 2 weeks ago and everybody signed up on the first day and was back in the office. So I think people are just anxious to get back there. And, so it's weird for me looking around and seeing my team every day. It's something that hasn't happened in a long time. So it's exciting. And I think, people are anxious to get back.
Thanks. Seth, I want to start with you on this one. Cell-based meats and alternative proteins in the next several years. What do you think?
I say it's low risk. Not worried about it.
Okay. How likely are you to have someone in your stores, Tony? Would you think of stocking cell-based protein?
I don't know. I've been thinking about it. I've been being hit by it a couple of times, and really, we're not sure how it's going to be perceived by the customer. I mean, it's just one of those things that nobody knows. And if you think about GMOs, I mean, is that not? And how that all goes down is going to be an interesting. We got to wait for it to really happen to be able to see how it gets.
And I'll just give a little more context to why I was so quick to answer it is because the improvements on plant-based just continue to accelerate. So it's not like cell-based will be coming out against what's out there today. If it comes out in 3 years from now, it's going to come out against a product. Beyond Meat just went to 3.0. It'll probably be coming out against 6 or 7.0.
Great. Chuck.
I mean, alternative proteins is a really big category. So, it's not really it's not really on my plate in my world. So I don't really see it a lot, a little bit, but it's out there.
And David, your thoughts on cell-based or alternative proteins?
I'm neutral. I'm not an investor in any, so I don't want to opine on it. But I am a huge believer in Seth, and I think he's going to revolutionize everything. So it's all good. Until all the private label comes in, and then we'll see.
Well, I think in some way or another, Seth is going to end up ruling the world, but it's just a personal opinion. So here's the last question in the lightning round. Most opportunistic meal occasion: breakfast, lunch, dinner, or snacking? Tony.
I choose to believe it's dinner for us. I believe we're trying to upgrade our presentation, and naturally it's gonna cause the check average to go up as well. But I believe that dinner is where we're driving right now for sure.
Okay, Seth, I think I know your answer, but
I have to say stacking now. I mean, obviously, Beyond Meat's going off after all those occasions, but I do think, snacking is such a big category. It's growing. And when you look at what is in the snack basket, it's striking how low nutrition dense it is. The other thing that's striking is we found this with Eat the Change. 6 crops account for 57% of all agricultural production. And so one of the things we did with Eat the Change is we said, we're not going to include corn, wheat, soy, rice, potatoes, or cane sugar. And when you leave those out, all of a sudden, there's a whole different world of food out there. So I think not just snacking on it as it is won't grow, but different kind of snacking will grow.
Terrific. David.
I think I'd probably go with breakfast, believe it or not. And a shout out to Chuck, because Pitaya is such an awesome product. And, I happen to be an investor in Samazon, which is using acai, but, all around, it's just a better world that my wife and daughter, instead of having Cheerios and Pop-Tarts, are having a nice acai bowl with almond butter and sliced fruit in the morning. I just think it's an area where there's going to be a lot of innovation, and Pitaya is going to play a great role in all of that. So,
Chuck.
Well, yeah, thank you for the kind words. And I would say snacking, and I would say like at-home snacking, right? It's like there's just so much more opportunity, and people are cooking at home, but the world that we're operating in frozen fruit and getting people to make a smoothie before their 3 p.m. Zoom call, like there's a big opportunity there, and they could just throw it in the blender and make it happen pretty quickly. So I feel kind of that at-home snacking. There's just more of it going on.
Yeah, and I'll just add, just to build on that, that's, the convergence of working from home also feeds less meals. So snacking, again, gets driven up when people work from home more, because they're not, going out to lunch or having that, meal they bring to the office.
Great. Well, listen, we have time for like a couple of questions here. I've received a bunch of questions from our colleagues in the audience, but I'd like to just take a few of these if I could. One is, what does the panel think about the pressure on pricing and maintaining selling prices in light of raw material and labor cost increases? I'll just open that up. Tony, do you want to take a shot at that, or?
I mean, our systems are set up so that when we see an increase, not on the food service side, but when we're talking about CPG products, right. we plug in a margin, and we unfortunately need to take a price change. As we're seeing things going up, it has to happen. Because labor's through the roof. We have hero pay. We've been since June 15th, I believe. May 15th. We've had hero pay. It's costing us crazy. $1 million a month is what the hero pay is. So we don't have any extra room just to swallow those margins, because a lot of people believe that it's going to come back down, and it's hard to see how inflation is just going to drop here in the next months. It's here to stay. We're in the roaring 20s.
Yeah. Any other thoughts from
Yeah, I'll just add. So yeah, no, it's real for sure. And look at this, the freight rates. You've literally seen the price of West Coast to East Coast freight double. So from 6,000 to 12,000. So that's obviously that's got to get passed on somewhere. But the one exciting area is that plant-based protein, or at least a company like Beyond Meat, is starting now to realize the benefits of scale. So whereas it always used to be plant-based protein was more expensive, what's happening is the meat industry is experiencing a lot of shortages. You're seeing chicken wings and things like that go short, and so their pricing's actually going to go up. And you're just going to start to see some of the plant-based protein companies start to realize the benefits of scale, and it'll start to come down. And I think that trend is going to continue. And I think 3 years from now, we'll be at a place where, well, let's call it 5 years just to be safe. 5 years from now, plant-based protein is going to have a pricing advantage. And that's where you get that whole flip. So it's exciting direction, even with all the things going on in the world.
I think it's going to hurt innovation a little bit. Like, I think for an established brand like us, we're kind of just biting the bullet right now, hoping for the best. It's not a long-term strategy. We're just not taking increases to Pitaya Foods to our retailers yet. I think it's probably on the 3 to 4 month horizon. But if you're a new starting out brand and you're at the mercy of these freight companies who don't care about, if you're shipping 200 containers and you think you're going to ship 1 container, it's going to be really hard to start scaling up as a young brand. So I think if you're innovating, you better be innovating. You better have supply chain in mind. And I think that's what investors are going to look at too, because they're going to look at their current portfolio and they're going to say, these are the supply chain disasters happening with these big guys. How am I going to invest in this small brand when, they're sourcing this from wherever? So unfortunately, I think it's going to hurt innovation as well.
The only thing that I would add to that is we actually have more recently decided to try a few price increases, and it's just too early to tell whether that was the stupidest thing in the world to do or not. But I would say to people who are entrepreneurs building brands, think about your brand and think about whether your brand deserves to be able to command a higher price, because it's all related, right? In terms of the value proposition that you're creating. And some brands are built to sustain that and some are not. And so it's actually, for an investor, a bit of a test on the integrity of that brand, right? It's like whether or not those things can stick or not.
Well, I think that brings us right up to the top of the hour. I want to honor the commitments of time constraints and really want to express my appreciation to all of the panelists. I know it's late back there, Seth, Eastern time. Thank you very much. David, Chuck, Tony, very grateful for you all taking the time out of your day and your business operations to share it with us in ACG. And Sheena, I see you're back. So those are my closing remarks. I'm very grateful for all of you, friends and colleagues.
Thanks. Great to be with y'all.
Thank you
Thanks,
so
Mike.
much, panelists. Everyone that is interested in joining the networking session, the Zoom information is in the chat box. The webinar is already up, so you're more than welcome to join. Thank you so much, Tony, Chuck, Seth, and David, for putting on a phenomenal panel. I actually learned a lot as a consumer, but thank you so much and have a wonderful evening. And thank you everyone for attending.
All righty. Thanks, everybody.
Thanks again, folks.
Bye-bye.
See you soon. Bye-bye.
Sheena.